Welcome back to the Deep Dive. Today we're tackling something big for financial advisors looking to grow, buying another practice.
Yeah, it's a huge move.
Definitely. It seems like the fastest way to scale up, right?
Yeah.
But boy, the complexity. Getting it wrong from that first handshake through to the integration, it can really derail things.
Oh, absolutely. Growth is the aim, but, successful acquisitions, they don't just happen by accident. They need a really disciplined, systematic approach.
Okay.
The material you shared lays out this pretty comprehensive 8-stage roadmap for M&A in the advisory space. So our mission today is to really dig into that framework, give you the key takeaways you need to actually pull these deals off.
I like that. Getting practical. So we're going from the big picture strategy stuff right down to the nitty-gritty accounting after the deal closes.
Exactly. And it's not just about the money, is it?
Doesn't sound like it.
No, not at all. The core idea here really is you need two things working together. You need that intense analytical rigor, getting the numbers right, the legal stuff, the financials.
Yeah.
But just as important, emotional intelligence. Managing the cultural fit, making sure the clients actually stay.
Ah, right. Because if you nail the numbers but lose the clients,
the deal's a failure. Simple as that.
Okay. That sets things up nicely. 8 stages. Balancing the art and the science here.
Yeah.
Let's jump in. Stage 1, pre-acquisition prep. The groundwork. So, okay, before you even think about looking at a seller, you, the buyer, have to look inward first. Define your strategic intent.
Absolutely critical.
Like, why are you buying? It's just pure growth, expanding geographically, getting specific expertise, or maybe it's a succession plan for someone retiring.
That why isn't just fluff. It drives who you look for and, frankly, how much you should even consider paying.
Right.
And alongside that why, you got to get your financial ducks in a row. That means, checking your liquidity, what you can actually borrow, understanding your own company structure. Are you an LLCS Corp, C Corp?
Oh, yeah.
Because that really affects how you can structure the deal for tax purposes later.
And the source material seems pretty insistent. Don't try this alone. You need a team in place before you start the search, who's absolutely essential early on.
Yeah, think of it as your core trio. First, an experienced M&A attorney. Someone who lives and breathes this stuff, ready for the LOI, the purchase agreement.
Got it. Lawyer.
Second, a CPA who specializes in tax structuring for deals. They'll handle that purchase price allocation we'll talk about.
Okay, CPA.
And third, crucially, a valuation consultant. Someone to give you a realistic, fair market value assessment and help during due diligence. Waiting until you find a target. You're already playing catch-up.
That's the homework done. Now, stage 2. Finding and screening targets. Where do these practices actually come from?
Well, the methods are evolving. You still have the traditional routes like industry networks, custodian referral.
Yeah.
But now you're seeing more specialized M&A marketplaces pop up. Places like Legacy Choice acting almost like matchmakers.
Interesting.
But wherever you find them, that initial screening, it needs to be rigorous, really rigorous.
Rigorous how? What are the key things you're looking for right out of the gate?
Well, beyond the obvious like AUM and profitability, you need to really dissect the revenue. Is it genuinely recurring? Or is it mostly transactional stuff?
Yeah, big difference.
Huge. Then you look at client demographics. Are they all about to age out, or is there growth potential? And a hard look at their compliance record is non-negotiable. You're looking for fit, yeah, but mostly you're screening for hidden problems, red flags.
Speaking of problems.
Yeah.
Confidentiality.
Yeah.
The sources stress putting up guardrails immediately.
Oh, absolutely. First step, basically. You need strong non-disclosure agreements signed right away, and make sure they include non-solicitation and data protection clauses.
Okay.
Before you see anything sensitive, you also need to confirm their legal standing. Check licenses, corporate minutes, basic tax compliance. You can't even start talking valuation until you know they are who they say they are.
All right, so we've got the intent, done the homework, found a seemingly clean target. Now for the really chewy part. Stage 3, valuation and deal structuring. This is where the analytics get serious.
Yeah, and it's amazing how often advisors just go with a gut feeling here. The source really pushes considering all 3 common valuation methods for comparison. Let's start with the EBITDA multiple.
Okay, that one's about profitability efficiency.
Exactly. The typical range mentioned is around 5 to 6 times normalized EBITDA, earnings before interest, taxes, depreciation, amortization. But here's the critical bit. Normalized. You absolutely have to adjust for the owner's compensation. If they're running tons of personal stuff through the business or paying themselves way over market.
You have to adjust that down to reality.
Or you'll massively overpay based on inflated profits.
Yeah, makes total sense. Okay, then there's the simpler one, the recurring revenue multiple. Seems very common for advisory firms.
It is, because it's straightforward. You just apply a multiple, often somewhere between 2.5 and 3.5 times, directly to that recurring revenue stream, whether it's AUM-based or retainers.
But there's always a but.
Yeah. The but is huge here. This method completely ignores the seller's expenses and, maybe even more importantly, the client age profile. Think about it. A practice hitting 3.5x revenue, but all the clients are 80 plus. That's way riskier than a practice at maybe 2.5x, where the average client is 50. Doesn't capture that risk.
Good point. And the third one, discounted cash flow, DCF. Sounds more complex. Why is that usually for bigger deals?
Because it's way more time-consuming, and frankly, it's built on assumptions about the future. DCF tries to project future cash flows, discount them back to today's value.
So it captures growth potential.
Exactly. If you're buying a firm because you genuinely believe you can take their growth from, say, 5% to 15%, DCF is really the only method that lets you quantify that potential value uplift. But it's heavy lifting.
Okay, valuation methods considered. Then comes the deal structure decision. Asset purchase versus stock purchase. Sounds like a major fork in the road. As a buyer, why push for an asset purchase? What's the trade-off?
Buyers almost always prefer an asset purchase. Why? Two main reasons. One, you get a basis step up, means you can write off or amortize the purchase price over time, reducing your taxes.
Nice.
Two, you limit your liability. You're buying specific assets, not the seller's entire corporate baggage, potentially hidden problems and all.
Okay, so what's the downside for the seller?
Usually higher immediate taxes for them compared to just selling their company stock. Yeah. So it becomes a real negotiation point, often comes down to leverage.
And to make that asset purchase work best tax-wise, there's a specific tax code section mentioned.
Yes, IRC Section 1060 is crucial. This section dictates how you must allocate the purchase price across different assets, specifically how much value goes to goodwill and the client list.
And why does that specific allocation matter so much?
Because that allocation is what allows the buyer to amortize those intangible assets, the goodwill, the client relationships over 15 years. It creates a significant long-term tax shield for the acquiring firm.
Got it. Big deal. Okay, that's the structure. Now, stage 4, due diligence. This is the trust but verify stage, right? Validating everything. What are we digging into?
Oh, pretty much everything. You, the buyer, need to see the seller's Form ADV, their public disclosure doc, all current client agreements, any disciplinary history, at least 3 years of tax returns.
You're looking for inconsistency.
Exactly. Does the reality match what they told you in stage 3?
And the source mentioned a horror story. Someone didn't check assignability and lost a huge chunk of AUM. What's the key operational check here?
That's the nightmare scenario. Yes, you check payroll, 1099 compliance, all that operational stuff. But the absolute must check is the assignability of client and custodian agreements. Meaning, do the contracts allow the relationship to be transferred to you, the buyer, smoothly? Or do clients need to actively re-sign or reapprove everything?
If they have to re-sign.
That's a massive client retention risk you have to factor in. If those agreements aren't assignable, you're not really buying a stable client list. You're buying a list of people you hope will sign up with you. Very different value proposition.
Huge difference. Okay, that leads right into stage 5, negotiation and the final agreement. Diligence is done, hopefully checked out. Now you make it legally binding. What are the key pieces of paper?
Right, moving from intent to ironclad docs. First, the main purchase agreement. This spells out all the representations, warranties, and critically the indemnifications, basically, how you're protected if something nasty pops up later that wasn't disclosed. Then you absolutely need consulting or transition agreements. These define exactly what the seller will do post-close, for how long, and for how much.
And locking them down.
Yep. Strong non-compete and non-solicit clauses. You just paid a lot for this business. You need to protect that investment.
Makes sense. And the source even mentioned some really advanced tax stuff here.
Yeah, for very large or complex deals, you might get into things like an installment sale election, Section 453, which lets the seller spread out their tax hit.
Yeah.
Or Section 338, 10 elections, which are, well, they're complex ways to treat a stock purchase like an asset purchase for tax purposes, benefiting both sides potentially.
Okay, definitely need the experts for that level.
Oh, yeah, that's where your specialist CPA and attorney really earn their keep.
All right, we've planned, analyzed, negotiated, signed. Phew. Now, execution. Stages 6 and 7, closing, and the critical post-acquisition integration.
Right, closing isn't just wiring the money, there's immediate regulatory work. The buyer has to file amendments to their Form ADV, update personnel registrations with U4 and U5 forms.
Okay, compliance stuff.
And, crucially for taxes, file IRS Form 8594.
What's that one again?
Form 8594 is where you officially report to the IRS how you allocated that purchase price across the assets, tangible stuff, goodwill, client lists. It basically locks in that 15-year amortization schedule we talked about earlier. You need to file it correctly.
Got it. Okay, compliance done. Now, stage 7. This is where that emotional intelligence really comes into play, isn't it? The client transition. That's like this is where deals can really succeed or fail post-close.
It absolutely is. The technical side, merging CRM systems, billing, portfolio software, that's important, sure, get it done efficiently. But the people side, that's the priority.
So how do you handle that?
It starts with really carefully crafted joint communications. Buyer and seller speaking with one voice. The message has got to be about continuity, maybe enhancement, not about radical change and disruption.
And it's just a quick email blast, I assume.
Oh, God, no, never quick. The source suggests joint meetings where possible, personal phone calls, tailored letters. The whole tone needs to be partnership. Reassure the staff their jobs are safe. Reassure clients their trusted advisor isn't just disappearing.
Right, they're partnering for something better.
Exactly. And that handoff period, it might take 6 months, maybe even a year, depending on what you agreed in the transition deal. Getting that smooth handover right directly impacts client retention. Massively.
Makes perfect sense. Retention is the goal. But back on the operational side, what does the buyer need to do immediately, like on their own books?
Definitely conduct post-close audits to confirm everything. If you finance the deal, set up reminders for debt payments. And critically, get the accounting right. Properly record the goodwill and those other intangible assets on your balance sheet so you can start taking that amortization expense. That impacts your reported profit for the next 15 years.
Okay, so after all that intense work, the integration chaos, what's the final step? Stage 8. Post-close review and optimization. Sounds like looking back.
It is. This is where you hold yourself accountable. You compare reality to what you expected. How did client retention actually turn out versus your projections? How about revenue?
Did the financial model hold up?
Precisely. Did the business perform as you thought it would back in stage 3? And you double check that all the regulatory filings, the tax stuff that Form 8594, the amortization schedule, were executed correctly so you're actually getting that long-term tax benefit.
And the point isn't just to see if you were right or wrong.
No, the real goal here is capturing lessons learned. What went well operationally? What were the cultural bumps? Documenting all that means your next acquisition hopefully starts smoother, learning from this one.
So, wrapping this all up, this 8-stage roadmap.
Yeah, when you pull it all together, it really reinforces that acquiring a practice is, like we said at the start, both an art and a science. The science gives you the framework, the discipline, the analytical rigor, but the art, that emotional intelligence piece, especially during integration, that's what actually delivers the value and makes the client stick around. You really need solid professional guidance every step of the way.
We definitely drilled down on the structure, the diligence, the numbers today. But let's end on that art piece, the legacy and retention aspect. If stage 8 is about learning lessons for the future, what's maybe the most critical cultural or operational lesson, something you can't just capture on a spreadsheet, that really defines whether you've preserved the seller's legacy and built lasting trust with those clients?
That's a great closer. I think it comes down to how you, the buyer, choose to genuinely honor the relationship the seller built. Is it just a transaction on paper, or do you actively work to show those clients you respect where they came from while offering them a strong future? That choice, that probably defines long-term success more than any single metric.
Something to really think about as you consider your own strategic moves. Thanks for joining us for the deep dive.